Thanks for joining us today for this week's iteration of our investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, we're going to start with our chart of the week here, which we've titled Manager Selection is More Important than Alternatives. So, we get this data from JP Morgan in their Guide to Alternatives. And we can see here what it's showing is performance dispersion over the last 10 years in different asset classes. So on the far left, the way to interpret this is large cap equity managers. The median performance has been about 9%, with top quartile managers returning over 10% and bottom quartile managers returning under 8.1%. So that middle 50% of managers has been in a tight band of less than 2 percentage points over the last 10 years on an annualized basis. Bonds, you can see in the next column, hardly any dispersion at all. And even in core real estate, a couple columns over from that, very little dispersion. But when you start to get into true alternative asset classes, we see massive dispersion among manager performance. So in non-core or more opportunistic real estate, you see very large dispersion in returns. Venture capital, very large dispersion of returns. Hedge funds, and what I think is interesting, and even private credit. And what I think is interesting here is that in a lot of these asset classes, median returns haven't even performed as well as the market. You really need to get top quartile returns to have performed better than just large cap equities. And so the point and the moral of the story is that manager selection is incredibly important when we're talking about alternatives. Proper due diligence is very important in those asset classes as well. So therefore, you really want to be selective in the alternative universe and not really just do any alternative that crosses your desk. All right, so looking at market action for the year and last week. Last week there was some corrective action at the back end of the week, but generally trends have been quite strong year to date so far. So we can see that S&P 500 has returned about 12.5%. International markets have certainly been a breath of fresh air, with developed international markets up over 25% and emerging international markets up over 30%. And a lot of these trends have been helped because bonds have done well. In other words, interest rates have fallen and the dollar's been weak this year. So those trends have helped to propel not just all asset classes, but particularly the international markets. So when we look at the economic data from last week, probably one of the bigger announcements on the week was consumer sentiment from the University of Michigan poll. We can see that in the last month, consumer sentiment has continued to slide lower, and it's now consistent with a level and a change in consumer sentiment that's consistent with very slow, sluggish economic growth. So what you can see from this chart here in the bottom box is that when sentiment has been strong and rising, the economy's grown over 3% per annum on an inflation adjusted basis. But when sentiment has been falling like it has been in the last few months, the economy's barely grown at all. So consumer sentiment being sluggish is in line with other things that we're seeing from an economic perspective that suggests that economic activity is slowing down here heading into the Q4. So another big thing that's happening this week is the earnings season is going to kick off for Q3. When we look back at Q2, it was a very strong earnings season. So what this chart's showing here in these orange bars is the percentage of S&P 500 companies that had positive earnings surprises, and that was about 81%, which is about as high a reading as you're going to get outside of something like the pandemic. So there was a lot of earnings beats in Q2. And what was going on there was analysts had really dropped their earnings estimates after Liberation Day, expecting that tariffs would negatively impact sales growth as well as margins. And companies were able to manage around those tariffs and still and beat those analysts' estimates. So that was a very strong quarterly earnings situation in Q2. And as we move to Q3, we think it's going to be a lot more challenging for companies to replicate that. Not the least of which because a lot of those Liberation Day dropping in expectations have been revised, and now analysts are expecting better earnings growth in the future. Now, what we can see here is that margins have in fact been rising. So I mentioned that they were able to preserve profit margins, and not just preserve, but grow profit margins. So in blue, that's the S&P 500 operating margin. And you can see that it's almost up at its record high after having some downside pressure in the prior few years. Now, what's abnormal here is in red, we're showing the unemployment rate inverted. So when that line's falling, that means the unemployment rate is rising. So you can see here that really since last year, the unemployment rate has been ticking higher, and margins have been increasing regardless. And that is not a real normal situation. You can see here that those series actually tend to track each other pretty well. They actually have a negative almost 60% correlation with each other. So this is abnormal to see softening economic growth, higher levels of unemployment, but margins are still expanding. And we think something's going to have to give in that dynamic, and that's probably going to be more on the margin front and potentially negatively impact earnings going forward. Now, we don't mean that to say that we think earnings are going to drop. Here we're showing an earnings model from Ned Davis Research, which takes into account about 10 different indicators. And they say, and all those indicators are geared to say, what's the macroeconomic environment like for earnings? And what you can see here in orange is that model is neutral. It's at 51% right now. So it's not necessarily a bad macro environment for earnings, but it's not a good macro environment either. It's a very neutral environment for corporate earnings. And a lot of that has to do with this slowing trend in economic growth. Now, the soft earnings environment and the softer macro environment is much more evident in what we would call the NIPA profits, which are economy-wide profits. They're not adjusted for the amount of shares outstanding, and there's a lot less accounting, creative accounting that can go on in the NIPA profits, and we show that in blue here. And you can see in orange that in the top clip, that's the earnings per share on the S&P 500. And you can see how that's just continued to make new highs, but NIPA profits actually fell for 2 consecutive quarters and have been more or less flat for a period of time. And so you can think of that as the NIPA profits are just essentially the total dollar profits that are being generated in the economy. So that it makes sense that as the economy slows and eases, NIPA profits have been flat to down, while S&P 500 earnings per share, on the other hand, have been continuing to go up. And it's also evident that you've had this softer economic backdrop in small cap margins. So I showed earlier how large cap company margins have been increasing in the recent few quarters, but small cap margins have been down in the last couple quarters. And you can see that in the gross margin in the second clip there on this chart. You can also see that sales growth in the top clip in blue has been easing for small cap companies as well. So small caps tend to not be able to execute as much from a buyback perspective. They tend to be more sensitive to the economic environment and more sensitive to the cost of capital. So as interest rates went up over the last few years, that was bad for small cap margins. So those large cap companies, what they've been able to do that small cap companies cannot is they've had a much better control of their labor expenses. We've seen that wage growth has continued to cool. New job openings have been falling. So as people are quitting, companies aren't necessarily replacing those positions. And the other big piece is that share repurchases or buybacks have really helped out large companies. So what we're showing here is the total dollar value in each quarter of repurchases in S&P 500 companies. And you can see that in Q2, they bought back almost $1 trillion of shares. So that is a major, major tailwind to earnings per share for the large cap companies. And that's something that the smaller cap companies have not been able to execute. That said, so there are some headwinds from a fundamental perspective and from a macro perspective, but market participation really remains solid, and we need to respect the trend of the market itself. So what we're showing here in orange is Ned Davis Research's Big Mo tape. And what Big Mo tape does is it lines up all the sub industries in the United States and it says, is it in an uptrend or is it in a downtrend? And so what the way you can interpret this is its reading is the percentage of sub-industries that are in an uptrend. And right now it's about 2/3 of sub-industries, which is a fairly healthy reading. You'd have to get down below 45% or so before it becomes kind of a negative condition for the market. So market participation is solid, and that has been helped by various things. One of those has been the transition from negative market sentiment to more positive market sentiment. So you can see here in orange, this is just a sentiment composite. And you can see how low it got around Liberation Day. Sentiment was very poor, and now it's rebounded back up into more optimism zone. And what we find is heavy amounts of optimism tend to be negative for the market. Returns tend to be more sluggish when there's a lot of optimism out there. But that first run to optimism following a major market bottom isn't necessarily a bad sign, and that's where we are today. As market participants have been going from pessimistic to optimistic. And one of the other things that has been backstopping this rally that we've had more recently is falling interest rates. So rates started to fall in anticipation of the Fed beginning their interest rate cutting cycle. Here we're showing in orange, we're showing corporate bond yields over the last 6 months. And you can see corporate bond yields are down about 8% over the last 6 months. And historically, that has been a good support, not just to the large cap stocks in the index, but like I mentioned earlier, small caps tend to be more sensitive to financing costs of the debt markets. So it has helped the average stock immensely. So falling interest rates is something that's potentially providing another tailwind to the market. So here's our closing thoughts for the week. Our chart of the week was on manager selection, very important in the alternatives asset classes. The top performing managers have done much, much better than the lower performing managers and even the median managers. So you really want to work hard to find those top managers. And we do internally at Signature FD spend a lot of time on manager selection in the alternatives universe. Now, economic growth is slowing, and we see that in various things in the labor market, but also consumer confidence, which has been easing. And we don't expect an imminent recession here, but certainly economic growth looks like it's slowing down and getting more sluggish. So that's something to be cognizant of. Now, the Q3 earnings season is about to get going here this week. And it's going to be a challenge to replicate the success of the Q2 earnings season. The macro environment's not necessarily supportive of very strong sales growth. So companies are kind of getting it done with cost controls and with share repurchases right now. But that can only go so far. You really need to see sales growth pulling its weight. Now, large companies, like I said, have done a nice job controlling its particularly labor expenses, and they've continued their repurchases. But economy-wide profits and small cap margins, those are things that are telling us that the overall macro regime is not that positive for earnings growth. That said, the cyclical bull market is certainly intact. It's been supported by falling interest rates of late, and market participation remains solid. We don't want to fight the Fed. We don't want to fight the trend, and those things are working in our favor. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.